The financial skies are darkening as storm clouds gather on the horizon. Many experts raise warnings of a coming recession, but one legendary investor gazes deeper into the tempest and sees an economic crisis brewing beyond anything we've encountered before. That investor is Jeremy Grantham. As a co-founder and longtime chief investment strategist of asset management firm GMO, Grantham has established himself over decades as one of the most influential voices in finance. His analysis of past bubbles and crashes have proven eerily prescient time and time again. Now, Graham's latest prediction suggests we may be staggering blindly toward an economic and market downturn more severe and systematic than a typical recession. Welcome to MoneyWise Investor, your trusted source for financial insights. In today's video, we'll delve deeply into the factors fueling Grantham's stark outlook and uncover his perspective on the swirling risks he sees converging into a potential perfect storm. Starting with 1. Market shrinking attention span. Grantham's pessimistic perspective stems in part from his observation of the market's shrinking attention span. In the past, significant financial events, wars, crashes, booms, captured investor focus for years. But today, attention fades faster. Markets ricochet from COVID to Ukraine to inflation, without fully resolving any one issue before latching onto the next shining object. This dynamic allows risk to layer stealthily. Imagine crisis triggers as snow piling up on a steep mountainside. Too much accumulates without ever sliding. Eventually, so much latent hazard builds up that when the next storm hits, it sparks an overwhelming avalanche, burying everything in the valley below. Similarly, Grantham worries today's ever-distracted markets allow instability in housing, overvalued stocks, fragile supply chains, inequality, and more to stack up largely unaddressed. Absent major policy interventions, these dynamics haven't fixed themselves. So when the next economic spark hits, the kindling lies dangerously dry for wildfire. 2. Potential 40 to 70% stock market crash. Tying directly to those risks, Grantham rings alarm bells about today's potentially extreme stock market overvaluation. The U.S. stock market trades at particularly elevated levels, dwarfing peaks before major crashes, like 1929, 2000, and 2008. Current conditions resemble past bubbles right before they popped. Specifically, Grantham estimates that the S&P 500 trades at least 50% above fair value, with a likelihood of 40 to 70% crash ahead to regain sanity. And when an index as influential as the S&P craters severely, history shows the ripple effects run deep. Businesses large and small see expansion plans disrupted as access to public market capital shrinks. Consumer confidence drops, spending slows, layoffs rise, and economic growth stalls, and society-wide purchasing power withers. Central banks typically counter recessions by cutting rates to stimulate borrowing and investment, but today's rates already hover near zero, unable to bail out free-falling markets. The overarching effects could prove devastating, especially if other chaos like wars or commodity price spikes strike simultaneously. 3. Skepticism of Bitcoin as a safe haven. What about turning to non-traditional assets if stocks sink? Cryptocurrencies like Bitcoin attract some investors as alternatives for crises. However, Grantham remains highly skeptical about crypto's reliability during the tempest he anticipates. Regulatory uncertainty, security challenges for investors, and extreme volatility concern him deeply. On the regulatory front, governments still actively debate how to oversee crypto. Stringent oversight seems likely, but unpredictable in scope and timing. Sudden unfavorable policies could severely undermine coin's value, right when investors expect shelter. Mass liquidations might follow, paralyzing buyers from exiting positions during the crisis. Additionally, hackers and scammers increasingly target cryptos, stealing funds worth billions annually. Worse yet, human error like losing passcodes permanently destroys access. Once safety nets for traditional assets, even dollar-denominated accounts at bankrupt FTX evaporated overnight, leaving no recourse. As world economies shudder, crypto's risk management shortcomings amplify. Finally, Bitcoin's stomach-churning volatility exceeds most other asset classes. Its price collapsed over 75% between November 2021 and 2022, shaking belief as an inflation hedge. Grantham argues Bitcoin's uncompromising algorithms, worshipping deflation, misalign with real economic needs, rendering it unreliable when circumstances shift radically. Traditional safe havens like farmland or bonds better weather storms. 4. AI acceleration's destabilizing effect. Shifting gears, Grantham also cites rapidly accelerating artificial intelligence as an economic wildcard. No doubt AI and automation will drive startling productivity gains. As software grows increasingly capable of assessing situations and making decisions, it unlocks potential for society-altering breakthroughs across industries. However, as AI propels growth at exponential rates instead of traditional linear ones, it risks leaving workforces behind, unable to keep pace. Remember, economic stability and societal contentment depend substantially on consistent wages and productive output balancing reasonably. But Grantham warns AI could displace human jobs faster than workers can reskill for newer ones. These risks depress consumer spending from surging structural unemployment, while simultaneous concentration of extreme wealth floods to those owning the automated technologies. These dueling forces, many locked out of income streams, while select elites reap exponentially bountiful tech rewards, sow the seeds for dramatic inequality and unrest. Without mitigating policies, AI's benefits concentrate excessively into too few hands, while most suffer financial insecurity and anger. This powder keg combined with the external shocks mentioned earlier, like market crashes, could unleash unprecedented instability. The critical question becomes, can policymakers implement guardrails to steer AI's rise responsibly by redistributing gains and retraining at scale? Or will short-sightedness rule the day, sacrificing social contracts between governments and citizens, sending recession toward depression or worse? How societies harness AI may dictate survival. 5. Volatility from Commodities Supply Stress. Rounding out his perfect storm recipe, Grantham spotlights commodities, from grains to oil, as further turbulence ingredients. Here, the core issues involve both supply chain fragility and food's vulnerability to climate change pressures. Russia's invasion of Ukraine already illustrated globalization's weakness by disrupting fertilizer, wheat, corn, and oil flows, which cascaded as higher food costs and fanned greater inflation in general. Now, magnify those shocks worldwide, as floods, droughts, and extreme weather poison harvests. Scientists consistently find climate change links to these yield-crushing effects and predict chronic challenges ahead. Less reliable crop yields, coupled with ongoing supply chain congestion and inventory reductions, will likely cause much greater commodity price volatility. And again, while number fluctuations on screens seem innocuous enough, commodity tremors historically transmit instability far and wide when severe. For context, rising bread costs directly fueled riots and unrest across the Middle East and North Africa in 2010 and 2011. More recently, Sri Lanka's economic collapse traces partially back to bans on chemical fertilizers, decimating tea and rice production. Put simply, when commodities vital for nutrition and warmth gyrate wildly in price, the most vulnerable citizens lose access first. It's hard to overstate how quickly peace deteriorates when families struggle to feed their children or heat their homes. Then, as unrest billows out, geopolitical shockwaves can shut down global supply chains, freezing trade sometimes for many years. Grantham sees these ingredients bubbling in the cauldron and worries about the consequences ahead. Next, possible actions to safeguard your finances. With Grantham's warnings in mind, what practical steps can you take to protect yourself financially in the years ahead? The first priority should involve securing reliable income streams and stable employment if possible. When economic contractions hit, companies almost universally cut costs to endure dips in revenue. Unfortunately, staff budgets rank among the largest line items vulnerable to slicing. That's why the official unemployment rate soared to over 14% after 2008's financial crisis, even though the technical recession lasted less than 2 years. Given projections for a long, ugly downturn this time, layoffs and hiring freezes could persist much longer. Make no mistake, even if we avoid Depression-era levels, the next decade may look nothing like the abundant last one for workers. So start preparing now. Learn emerging technologies or processes in your field. Meanwhile, polish that resume and LinkedIn presence, drawing connections to former colleagues now at other firms. Stay visible gathering intel on roles you're qualified for elsewhere, should the need arise. Next, construct all-weather investment portfolio. Beyond career defense, investors should increasingly emphasize resilience in portfolio construction as markets teeter. Grantham repeatedly advocates balancing investments across asset classes and even holding extra cash during turbulent times. Specifically, he suggests trimming exposure to potentially overvalued stocks, especially higher-risk ones. Simultaneously, he recommends gradually increasing weight toward historically stable securities like Treasury bonds, inflation-protected TIPs, and blue-chip dividend stocks across sectors. For example, prioritize companies furnishing electricity, food, and other basics society will keep needing regardless of economy. While admittedly not flashy, these securities act as ballast amid storms. Mix the bonds and defensive stocks with intermediate-term government debt funds, gold, and diversified commodities to smooth volatility. Top it off with 2 years' worth of living expense cash to avoid liquidating items at panicked lows. As a final pillar, instilling a long-run perspective represents the next key step for enduring choppy conditions ahead. Seasoned investors understand markets fluctuate wildly in the short run, while underlying structural growth trends play out over decades. But inexperienced traders often abandon promising assets at precisely the wrong low points, never benefiting from inevitable upswings. Don't join their ranks. When economic troubles multiply and markets plunge, knee-jerk panic causes many to sell solid investments merely because their prices dropped. But price and value differ enormously. Sometimes the highest quality companies and funds fall the most in panics, making them amazing bargains for those with patience and discipline. So start training your mindset now to interpret short-term noise as largely irrelevant to long-term results. Commit to a strategy of regularly investing fixed amounts into your balanced portfolio, regardless of market skies on any given day, week, or month. Tune out the dramatic daily headlines to see the sweeping vistas ahead. In conclusion, Jeremy Grantham gazes ahead and perceives a brewing economic crisis whereby multiple spinning plates, overvalued stocks, digital disruption, commodity squeezes all simultaneously lose momentum, crashing down in tandem. Rather than a typical short recession, he envisions sustained global instability ahead, marked by inflation, failing harvests, unemployment, and more. The long-term outlook turns stormy indeed. And yet, even under the darkest skies, room for hope peeks through. The way forward promises high volatility, but with preparation, savvy, and flexibility, you will emerge stronger for having navigated the stormy seas. Now, we want to hear from you. What proactive financial steps are you taking in response to current global dynamics and projections ahead? Let us know in the comments section below. And if you enjoyed our time together and found value in these lessons, we'd greatly appreciate it if you could tap that like button. And if you would like to join us on more wealth-building adventures, make sure to click subscribe and turn on the notification bell. Until next time, stay money-wise.